Hello, good day. I hope you are safe, healthy, and fine. Today, the title of this video is Making Capital Investment Decision. This video delves more deeply into capital budgeting and the evaluation of investment projects. We shall discuss the major concepts involved in evaluating capital investment, such as incremental cash flow, operating cash flow, change in net working capital, depreciation, scrap value, and interest expense. Investing in fixed assets is an important decision for business. At the end of this learning session, it is hoped that students will be able to identify the relevant cash flows that should or should not be included in a capital budgeting analysis. In addition, students will be able to apply the net present value analysis in detail. This knowledge is important in helping companies to make better capital investment decisions and achieve its profit maximization goal. Stay tuned and let's learn together. Investing in fixed assets is an important decision for business. A key responsibility of financial managers is to review and analyze proposed investment decisions to make sure that the firm undertakes only those that contribute positively to the value of the firm. Financial manager can compute the net present value of a project and only accept those for which the NPV is positive. The net present value is the total of the present values of all projected cash flows. The net present value techniques discount cash flows, not earnings, as earnings do not represent real money. Take note that only cash flows that are incremental to the new capital budgeting project should be considered. What are incremental cash flows? Well, we shall explore further. To evaluate investment opportunities, financial managers must determine the relevant cash flows associated with the project. What are the relevant cash flows? Well, the general principle is simple enough. A relevant cash flow for a project is a change in the firm's overall future cash flow that comes about as a direct consequence of the decision to take that project. As the relevant cash flows are defined in terms of changes in the firm's existing cash flow, they are called the incremental cash flow associated with the project. The incremental cash flow can be both outflows and inflows. Outflows represent investment and inflows represent return. There is a difference between cash flows and accounting income. The present value of cash flows, not accounting income, is the basis of a firm's value. That's why we discounted net cash flows, not net income, to find projects' net present values. In this slide, I list down some examples of incremental cash flow. The cash flows of any project can also be classified as initial investment, operating cash inflows, and terminal cash flow. When estimating the relevant cash flows associated with a proposed capital expenditure, the firm must recognize any sunk costs, opportunity costs, side effects, allocated costs. These costs are easy to mishandle or ignore, particularly when determining a project's incremental cash flows. A sunk cost is a cost or cash outlay that has already occurred in the past and cannot be recovered in the future. Because sunk costs are in the past, they cannot be changed by the decision to accept or reject the project. Sunk cost has no effect on the cash flows relevant to the current decision. Just as we let bygones be bygones, we should ignore sunk costs. Sunk costs are not incremental cash outflows and should not be included in a project's incremental cash flows. In capital budgeting analysis, we are concerned with future incremental cash flows. We want to know if the new investment will produce enough incremental cash flow to justify the incremental investment. What is opportunity cost? If the asset is used in a new project, potential revenues from alternative uses or other opportunities are lost. Those lost revenues can meaningfully be viewed as costs. As such, they are called opportunity costs. Opportunity cost can also be defined as the best return that can be earned on assets the firm already owns if those assets are not used for the new project. With new investment, changes in cash flow may come from the side effects of the proposed new projects on other parts of the firm. For example, erosion occurs when a new product reduces the sales and the cash flows of existing products. On the other hand, synergy occurs when a new project increases the cash flows of existing projects. In this case, the cash flows from the new project should be adjusted to reflect the impact of the side effects on other existing projects. In business, a particular expenditure benefits a number of projects or departments. Normally, the accountant would allocate these costs across the different projects when determining income. However, for capital budgeting purpose, this allocated cost should be viewed as a cash outflow of a new project, only if it is an incremental cost of the project. After learning about the four types of costs, let's have a quick quiz to test your understanding. There are four examples in this slide. Draw a line to match the examples to the right type of cost. Happy trying! The answer in sequence is sunk cost, side effect, allocated cost, and finally opportunity cost. Which type of cost should not be considered as incremental cash flow? The answer is A, sunk costs. In your textbook, there is an example on Wheelballs Limited. The example is about how the company is considering to purchase a new machine for production. I would encourage you to read the example and try to compute the net present value of the project. The content of the example is summarized into 8 points. I will provide you with a spreadsheet on the analysis in Blackboard. You are strongly encouraged to read the textbook for details. The initial investment refers to the relevant cash outflows to be considered when evaluating a prospective capital expenditure. Initial investment occurs at time zero, the time at which the expenditure is made. Examples of the cash flows that must be considered when determining the initial investment include the installation cost of the new asset, the after-tax proceeds from the sale of an old asset, opportunity cost, and the change in net working capital. The initial investment is calculated by subtracting all cash inflows occurring at time zero from all cash outflows occurring at time zero. Pro forma financial statement is a convenient way to summarize the relevant information for a project. To prepare this statement, we need to estimate some variables. For example, unit sales, the selling price per unit, the variable cost per unit, total fixed costs, and depreciation. Assets are depreciated according to the tax rules that apply in each country. Several different methods are used to compute depreciation. The simplest method is straight-line depreciation, in which the asset's cost less any expected salvage value is divided equally over its estimated useful life. Reducing balance method is also common. Assets that are no longer needed often have a resale value or some salvage value if the parts are sold for scrap. Salvage value is the proceeds from the sale of an old asset. It is the amount net of any removal or cleanup costs expected on termination of the project. The book value of an asset is its accounting value. It can be calculated by using the following formula. Book value is equal to installed cost of asset minus accumulated depreciation. Three potential tax situations can occur when a firm sells an asset. These situations depend on the relationship between the asset's sale price and its book value. The asset may be sold for more than its book value, for its book value, or for less than its book value. We can calculate the gain or loss on sale of asset based on the difference between the sale price and the book value of the asset. For a gain on sale of asset, the gains above book value are taxed as ordinary income. For a loss on sale of asset, the loss is deducted from ordinary income. What is net working capital? Net working capital is defined as the difference between current assets and current liabilities. Net working capital represents an investment of cash flows in the current assets and liabilities of the firm. These are short-term in nature, since they are used in the operationalization of the project. The main components of net working capital are cash, inventory, receivables, and payables. Change in net working capital is the difference between the change in current asset and the change in current liability. Change in net working capital can also be calculated by comparing the net working capital this year with last year, as shown in the formula. It is important to note that changes in net working capital often accompany capital expenditure decisions. Firms must maintain an investment in working capital. An investment in net working capital arises whenever current assets increase. For example, firms will purchase raw materials before production and sale, giving rise to an investment in inventory. It will maintain cash as a buffer against unforeseen expenditures. Firms also need more cash to support increase in accounts receivable whenever credit sales are made. In contrast, investment in net working capital is reduced by increase in current liabilities. For example, credit purchases which generate trade payable reduce investment in net working capital. Change in net working capital will have an impact on cash flow. If current assets increase by more than current liabilities, change in net working capital is positive. resulting in an increased investment in net working capital. This increased investment is treated as a cash outflow. On the other hand, if current assets increase by less than current liabilities, change in net working capital is negative, resulting in a decreased investment in net working capital. This decreased investment is treated as a cash inflow. At the start of a new capital investment project, we take into account any change in net working capital that is attributable to the new asset. During the project life, the changes in net working capital represent further cash flows from year to year. When the project is about to end, the change in net working capital represents the reversion of any initial working capital investment. This will show up as a cash inflow due to the reduction in net working capital. At the end of the project, all remaining inventory is sold off, trade receivables are finally collected, and the project's cash buffer is returned to the corporation. Therefore, net working capital is reduced to zero with the termination of the project. The amount recovered at termination will equal the amount shown in the calculation of the initial investment. Typically, corporate worksheets treat net working capital as a whole. Change in net working capital can be calculated by comparing the net working capital this year with last year, as shown in the table. When change in net working capital is positive, the impact on cash flow is negative. In financial reporting for accounting purpose, we must deduct interest expenses from earnings before interest and tax to compute a firm's profit before tax. However, when evaluating a capital budgeting project, we generally do not deduct interest expenses. In capital budgeting, firms calculate a project's cash flows under the assumption that the project is financed only with equity. Any financing-related costs, including interest paid, principal repayment, dividend, will not be included. Any adjustment for debt financing are reflected in the discount rate, not the cash flow. This is because we are interested in the cash flow generated by the assets from the project. Interest paid is a component of cash flow to creditors, not cash flow from assets. Any incremental interest expenses will be related to the firm's decision regarding how to finance the project. The particular mixture of debt and equity a firm actually chooses to use in financing a project is a managerial variable and primarily determines how project cash flow is divided between owners and creditors. Therefore, we evaluate the project on its own, separate from the financing decision. This means we calculate the project as if the company will not use any debt to finance it. For this reason, we refer to the net income as the unlevered net income of the project to indicate that it does not include any interest expenses associated with debts. This is not to say that financing arrangements are unimportant. They are just something to be analyzed separately. Operating cash flow does not consider non-cash items such as depreciation and amortization. Depreciation is an expense that does not involve any cash outflow and does not reduce the cash flow in the firm. There are three approaches to calculate operating cash flow: the bottom-up approach, the top-down approach, and the textual approach. The formula are given in the slide. All the three approaches give the same operating cash flow. Before I end this presentation, I'm happy to tell you that I have prepared a full working of the real ball example in Excel spreadsheet. It is available in Blackboard. I hope you will try on your own and check your answer. I understand it has been tough to be on your own during the COVID-19 pandemic period. We shall try our best. If we believe we can do it. Happy learning! Finally, we have come to the end of this video. I hope you have benefited from the presentation and content in this video. If you like this video, please click like, subscribe or share. Thank you, see you and goodbye.